we are now going to go to one of our key themes for the day, which is to really look at how we can explore and elevate the role of investors. So we're seeing a lot more interest in socially conscious investors being concerned about where their money is being put into companies and looking for those that have a positive impact. So looking beyond the returns, but as Matt said, still wanting profitable returns. But the result is that we are now seeing that ESG criteria are becoming part of the mainstream investing. I wrote a blog in the last few days, which hopefully some of you saw. And my question was really, are we focusing too much on the environmental and governance aspects and not looking as closely and with as much focus as we need on the social impacts? So I'm thrilled to welcome a very distinguished and global panel to the stage to talk about whether we need to put the S back into ESG. So Petra, do you want to come up and join us on stage? Petra will be leading the panel here. She is the asset management specialist for Thomson Reuters based in our Singapore office, and she's also our ESG ambassador for the region. We have Måns Carlsson-Sweeny, head of ESG research for Ausbil Investment Management, joining us all the way from Australia. Bennett, head of investment stewardship for Blackrock in Asia, based here in Hong Kong. Paloma, Munoz, the program director for the Investor Alliance for Human Rights, who made the trip from New York to be with us. And Samantha, Bramley, director of Environment and Social Risk Management for Standard Chartered, also joining from Singapore. So thank you, and I look forward to a fabulous panel.
Thank you, Kimberly, for the introduction. Well, it might not be such a historic day as landing on the moon, but I think that this is quite a unique moment for Thomson Reuters because it is the first time that we are including ESG as one of the panel discussion topics at the Asian Stop Slavery Summit. This probably shows you the growing importance of looking at ESG from an investor perspective. And modern day slavery is actually probably one of the most challenging ESG issues to look at, mainly because it's intangible and it's very difficult to measure. So this lack of disclosure by companies is actually very problematic for investors because the investment community likes transparency. And without the lack of disclosure, it becomes very difficult for them to see to what extent their portfolios are exposed to modern-day slavery risks. So in preparation for this summit, we did a quick research using Thomson Reuters ESG data, and we wanted to see how many publicly listed Asian companies make any disclosure about their policies on forced labor and child labor. And the result is actually quite shocking because out of the 29,000 plus publicly listed companies whose headquarters are in Asia, only 304 of them make any transparent disclosure around their policies on child labor and forced labor. And just as a way of comparison, this number was actually less than 100 companies 3 years ago. So the purpose of our panel today is to discuss why investors should care about modern-day slavery, and also how they can actually help their investee companies to tackle and understand the issues around child labor and forced labor. So I very much look forward to hearing the opinions and thoughts of my panelists. And what I wanted to start with is basically, state that ESG is not really something that investors in Asia look at. And I wanted to see whether the panelists can share why it's actually important from the investor perspective to look at modern day slavery and how they can actually help their investee companies to tackle this issue. So we have quite a nice spectrum of speakers here. We have a passive investor, active investor, non-profit organization, and the bank. So hopefully it will be quite a heated debate. Prue, do you want to start?
Thank you very much, and thank you for having me speak at this really fantastic conference for such an important issue. So I head up what's called investment stewardship for Blackrock, and Blackrock is a large US-based asset manager. And while we have many different types of investment strategies, one of the dominant ones here in Asia is passive. So it means it follows an index. So ESG is not taken into account in portfolio construction. So we find ourselves invested in a variety of companies, and some of which have very poor ESG practices, and that would include modern slavery. Selling's not an option for passive strategies, so we have two tools, and that is voting and engagement. And we do an ESG assessment, particularly around the voting time, that will highlight where modern slavery may be an issue in the company. And when we engage, we do try and engage at the board level. In jurisdictions such as Australia, getting access to the board is very common, and we can have discussions and have had very good discussions around modern slavery for Australian companies that are exposed. However, in Asia, engagement with foreign investors at the board level is something that's very new. And so when we've had these discussions, in fact, not just on modern slavery, but many ESG issues, it is a new discussion for the board. And unfortunately in this region, boards see ESG as a compliance issue. It's a tick-the-box approach. All boards have a third of the board independent. They all have a nomination, audit and remuneration committee. They don't look at it as a strategic issue. We see it very much as a strategic issue, because if these risks aren't managed, they will impact they have the risk of impacting performance over the longer term. And being passive, we are long-term investors. We can't sell. And many of our clients are pension funds that have very long-term investment horizons. So this is very much an issue for us that we see as a financial issue if it's not managed well. And when it comes to companies spending money on this we see that as an investment that should contribute to the long-term sustainable returns of that business.
Thank you.
Thanks for having me. I thought I might just touch on the relevance of ESG first, because I think ESG might mean different things to different people. For us, it really comes down to two things. So that's better informed investment decisions and active ownership. And I head up the ESG research team at Ausbil, so we're an Australian-based firm that mainly invests in Australian companies. And the research we produce is very much integrated in our investment process, so we're very much part of the investment team and the decision-making process there. And with the relevance of ESG, I really think the way we try to use it is to capture insights that might be overlooked by the market. So for instance, we have a long short fund, and on average about 50% of the short positions have actually come from or been very strongly aligned with our ESG views. So ESG for us is also a way to generate alpha and make returns. And it's always annoyed me a bit when people say the S in ESG is sort of a soft and fluffy part, because some of our most successful shorts have actually come from the S in ESG, particularly when it comes to underpaid labour. There's been quite a few of those cases. When it comes to the relevance of modern slavery for us, I think it just comes straight back to our own investment philosophy. So we're an active manager, as Petra said before, and for us, share prices are driven by earnings revisions, but we also prefer companies with sustainable earnings and companies with quality management, so three components. On earnings, of course, brands are key assets. Brands are very vulnerable. Brand damage can lead to loss of sales. That's the first aspect. Second thing is earnings sustainability then. Of course, as investors, we prefer stable earnings. But if you look at a business model, if it relies on or depends on underpaid labour, weak regulation or social issues, or even slavery in some supply chains, those earnings are not going to be sustainable forever. But it's not just about earnings. I think quality of management is a really important aspect too. So we often see ESG as a bit of a proxy for management quality. So for instance, if I speak to a retailer's CEO and I discover that they're paying lip service to labour rights in the supply chain, or they don't even know their own supply chain, as an investor you can't help thinking, what else should I worry about? Because we want to invest in companies that are resilient, forward-thinking and ahead of a curve. And from a practical perspective, that can also influence our valuation, because if we find that a company has poor management quality, we think they should be trading at a discount to its peers. So when we then value that stock, we might apply a lower earnings multiple. And then it's not just about that, it's also about increased regulation as well. I mean, we've seen the UK Modern Slavery Act. In Australia, where I'm from, we're about to have a Modern Slavery Act as well. And then globally, we see more and more regulatory focus. So I think it just comes back to what I said before. We want to invest in resilient companies. And then, of course, clients. Clients are getting more and more interested in and engaged in ESG issues, and particularly slavery. So, and particularly young people. So I don't think we'll see an end to that trend anytime soon. And I mentioned before up front that ESG integration means two things for us. So you've got the better informed investment decisions, but also active ownership, which Prue also mentioned. On active ownership, I think there's a couple of important points to make. First of all, because we're based in Australia and we mainly invest in Australian companies, we've got a fairly limited universe to choose from. You can't really be picky. And because of that, I think we're just naturally incentivized to engage. And because it's a small market, we also have good corporate access. And a couple of years ago, someone asked me, would it be possible to construct a portfolio that's guaranteed to be slavery-free? I mean, obviously that's not going to be the case, but what we want to see is companies trying to do whatever they can to mitigate the risk of slavery in their supply chains. And as an active investment manager with concentrated portfolios, we can be quite influential. And our focus when it comes to engagements with companies really comes down to encouraging companies to adopt industry best practice. So these are things we can pick up on by going on a field trip, for instance. I've been to quite a few, for instance, to Bangladesh. I'm going to Cambodia quite soon. And you can learn what leaders are doing. You take that back with you to Australia and you try to make companies adopt industry best practice. So we've got a number of quite specific points that we raise with companies in terms of what we think that we should be doing. So by engaging, you can expand your investable universe, you can also preserve your invested capital, but also you make those better informed investment decisions, because one thing, as you mentioned about the Australian Modern Slavery Act, is it's going to apply for us too. So as investors, we need to report on our own holdings and the risk of slavery in our portfolios. So it's a bit of a chicken and egg situation, because obviously we've got a vested interest in engaging with companies to report well. But in the meantime, I think engagement is probably the best way to actually understand how companies are running their risk management.
Thank you. Paloma, from a non-profit perspective?
Perfect. Thank you, Petra, and thank you all for being here. I think this is for the Investor Alliance for Human Rights and the investors that I represent. It's an honor to be here with you all on this very important event, which is obviously addressing a key concern for the investors that I work with. The Investor Alliance for Human Rights is a new alliance of investors of all different types: public pension funds, large asset managers, SRIs, faith-based, trade union funds, etc. We have over $3 trillion worth of assets under management. And obviously all of the investors that we work with are very concerned in particular on the issue of human rights, of forced labor and human trafficking in the supply chains of the companies they invest in. And I think one thing that's very important to state up front, and I think we'll touch on it a little bit better, is that, how do we define S? I think that from a human rights perspective is absolutely key. The S of ESG is human rights. Human rights are actually very clear standards that have been agreed upon by governments at the global level. They include economic, social, and cultural rights. They include civil and political rights. They include labor rights. And we can come back to this a little bit later, but I think it's important to note that, because I think oftentimes there's quite a bit of confusion when we talk about what do we mean by S exactly. And so from the perspective that I'm coming from, I think that my colleagues on the panel have made a great, excellent point about why not doing ESG is a major risk for investors. There is no doubt not taking that perspective into consideration poses significant financial, reputational, et cetera, risks. But there's another reason, and I'll talk about that right now. Investors as well as companies actually have a responsibility to respect human rights through their operations and through their business relationships. In 2011, the United Nations Human Rights Council unanimously adopted what's called the UN Guiding Principles on Human Rights in Business. These guiding principles, what they do really is clearly delineate what are the responsibilities of governments on the one hand, businesses on the other, with respect to human rights. And very clearly they say that governments should protect human rights from third parties, including corporations, that businesses should respect human rights through what's called human rights due diligence, and that both must actually provide remedy to victims of human rights abuses that are related to corporate conduct. Now, what does this mean in practice? It means that companies, irrespective of how the state, the governments, protect, for example, the rights of workers, of migrant workers, of communities, et cetera, companies themselves must respect human rights by, for example, identifying, assessing, and addressing potential human rights risks, and in this case, labor risk or forced labor risks in their supply chains. This is a responsibility that really applies to all companies of all sectors, and it requires them to commit to respecting human rights, having a public policy on human rights. In this case, also identifying what their salient human rights risks are, and that includes, for example, forced labor in the supply chain. They must inform investors and other stakeholders around how they're actually taking steps to implement that policy into their operations, how they're assessing impacts, how they're communicating with potentially affected rights holders, including potentially victims of forced labor and modern slavery, how they're tracking their response, how is this implementation effective, and are they remedying victims of adverse human rights abuses? This is a standard process. Now, I'll leave it at that to say, though, that this responsibility actually applies to investors as well, because investors are also businesses. And the OECD last year developed a guidance for institutional investors on responsible business conduct for investors, which basically unpacks step by step how investors need to go about meeting the responsibility that's been established at the UN level. And this guidance is available online and is in fact very clear. Now I want to make the key point here that this is obviously a responsibility, but it is also a risk mitigation tool for investors as well as companies. And we just spoke about all the risks that exist. And so I think that's important to note, and I won't touch on it again, except though I do think it's also important to note that it's also an opportunity for investors. I mean, there's clear evidence now that suggests that companies that are really looking at their ESG risks and impacts are also correlated. They're also showing positive returns, financial returns. I think on the other hand, there's also clear evidence that millennials in particular are looking to invest in companies that are actually conducting ESG, that are taking forth, implementing what's called human rights due diligence, and therefore this is clearly a market for investors to be focusing on moving ahead. And I'll just note that, for example, US Trust, I think last year, found that 76% of millennial investors are actually looking at companies that do ESG, as opposed to the overall 34% of investors worldwide. And I also think it's important to note that women are much more concerned with investing their funds in companies that are incorporating ESG criteria. And guess what? Women are also increasingly involved in investment. They're a growing community within that space. So I think that overall the trend is clear. So for investors, this is a key issue, and everyone should be looking at ESG in their investment portfolios. Thanks.
Samantha from Standard Chartered.
Thank you. So I work in the environmental and social risk team at Standard Chartered, and in particular, I look a lot at human rights and social impacts of both the clients that we have as a bank and also the transactions that we are part of and the projects that we invest in. And I think, respectfully, I would actually disagree a bit with Petra's assertion at the beginning that human rights is intangible, because I think what we're seeing is it is becoming clearly tangible. I mean, first off, from a legal perspective, Standard Chartered is obviously headquartered in the UK. 2015, the UK was the first country to actually come out with some modern slavery legislation, which was based very heavily on the Californian Transparency in Supply Chain Act. And I think we are going to see many companies following suit. Obviously, Australia is in the midst of debating right now about some legislation on modern slavery. So is the Netherlands, so is France. And I think it is going to be enshrined in legislation more and more around the world. And for countries that are not necessarily looking at bringing in specific acts against modern slavery, most countries around the world have ratified ILO conventions on abolition of forced labour. And those conventions are then translated into both criminal law in those countries and labour law. So I think there is definitely a growing risk for investors that if companies are not looking at these issues, there is potential for prosecution, for fines. I always think Brazil is a very good case study of all of these issues. In 2004, Brazil came up with an idea of a dirty list of companies, and it would literally name and shame companies that had been exposed for having modern slavery in their supply chains. And between 2013 to 15, they actually fined 300 companies. Within that same legislation, they also were able to confiscate property from companies who were deemed to have profited from modern slavery. And in fact, and a sort of turnaround, despite all the good work the Brazilian government was doing, they in fact themselves got fined $5 billion for by the Inter-American Court of Human Rights, who basically in turn made them pay up on behalf of a group of agricultural workers that had themselves been kept in slavery-like conditions. So, it's happening at every level. Obviously, there's been a lot of talk about, tangible impacts on reputation. We see direct correlations in our clients where they are exposed for these issues, whether rightly or wrongly. There are impacts to share price. There is a loss of not only investor confidence from our perspective, but obviously from consumer boycotts. So I think it's becoming increasingly tangible. If you don't get this stuff right, your name ends up in the papers, as I say, proven or unproven. There are immediate hits on things like share price. And obviously then profits. I think a really sort of classic case recently, which many of you have probably heard about, was a company called Pure Circle that does natural sweeteners, who had all of their imports into the US impounded, basically because there were allegations that were actually later disproved, but nevertheless allegations that Chinese prison labor was used on their plantations to produce this leaf that's used as a sweetener. And it had massive damaging impacts to that company, and slightly regrettably because they were later disproved. But I think you can't ignore these issues anymore. They will impact your profit lines directly, as far as I'm concerned. But I think, we talk about a lot of the negatives, and this discussion has been very sort of focused on those. But I think what I would really like to see happening, and what we are trying to push with our clients, is to start framing this in the positives, in the positive impacts, that have been talked about just now, in terms of actually, as much as it can hit your bottom line, it can positively impact your bottom line when, you start adopting some of these positive behaviours. You find decreased staff turnover, you find lower injury rates when you're looking after your staff, when you start giving them medical, there's less days off, in sick pay. There are a lot of positives. And I think what I'm really keen to see is that we start breaking some of these taboos. I think, as we've all acknowledged, there is not you know, a person in here whose company, bank, whatever, doesn't have slavery in their supply chains. You know, we've got it in our clients in the bank. There's no point admitting we don't. It's a reality for every single product, I think, out there that's somewhere in the supply chain. It will be there. So I think we need to just start taking the taboos away from this, start getting more acknowledgement of the issues, more transparency. I mean, another classic case, you know, Nestle have come out and said, yes, of course we've got, you know, slavery in our Thai fishing supply chain. Of course we have. And they were brave enough to come out and say it and say, okay, we've got it, now we're going to deal with it, and you can track our progress. That needs to happen all over the place. And I think learning from a bank perspective, you know, we have, you know, up to now been, of course, asking all of our clients, you know, do you have, you know, modern slavery in your supply chain? Of course, the answer is no. You know, how horrific. Of course we don't have modern slavery. So we realised that was a really ineffectual question. You know, the same with child labour. Have you got child labour in your company? Oh my God, no, we've got no child labour. Great, tick the box. And we realised that actually this wasn't protecting us from the risks that then came out when, you know, 2 months later, front page of the headlines, they've got child labour. So we're having to reframe the whole questions. You know, we're now trying to say to clients, okay, you know, do you think there are any areas of your supply chain that have a risk of exploitative labour practices? Now that question is very hard to say no to, and I think that's where we have to start the dialogue.
Thank you all for sharing. So I think we have established quite clearly that it is important for investors to look at modern-day slavery, but certainly it is a challenging topic, right? And what I would like to hear is, you know, what are some of the challenges that you face when you speak to your investing companies or any of your clients that you engage with? Because certainly it's, you know, it is difficult to tackle and understand, right?
I think one of the key challenges in Asia, and I touched on this before, is the fact that companies don't see this as a strategic issue that needs to be managed, and there's very little disclosure. A lot of companies here, and it's in fact in Hong Kong it's a requirement under the listing rules to produce a CSR report, and I can describe most of them as being the front cover of the board wearing white helmets and orange vests. Page 2 is the chairman handing a cheque over to his or her favourite charity, and page 3 is a picture of the staff doing a fun run. Now that's not to say if the board's in a dangerous construction site they should be wearing safety gear. It's okay for the chairman to hand a cheque over to his or her favourite charity, but it is shareholders' funds, and it really does need to be strategic to the business. And staff fund runs are very good for cross-functional inclusivity, but that's not what's brought out in these reports. And in fact, I'm convinced that most of the time the board doesn't even see them until they're distributed to shareholders. So our role here, I believe, is to make boards aware that this is a strategic issue that we want to see managed and on their risk register. So we do have discussions around boards about the risk register, and you get, sorry, what's that? And explain to them that it should be reviewed regularly by the boards. Boards here generally only meet 4 times a year, which is not often enough to review a risk register. But to explain to us, you know, what they're doing, what the governance structure is around this issue. And it isn't a case of just saying to a company, well, if you think there's slave labour in from supplier A, don't just switch to supplier B, work with that supplier and change the function within that supplier and improve the supply chain. Just don't go and drop that and go to another one, because that doesn't provide long-term solutions. And I believe if companies are transparent around these issues, and as been said before, it's impossible for companies to say, or most companies to say, there's no slave labour or modern slavery in my supply chain. To be that transparent, I think will make it more attractive to investors, because investors can see that the risk is being managed. And if you can increase demand for your stock, that has implications for overall cost of capital. And so we do provide companies with examples of other companies that are doing good jobs. That's generally outside of Asia. And we've just got to keep pressure on boards on this issue to ensure that we can sort of change that mindset of seeing ESG as a compliance issue. And there is a real challenge here also with the quality of independent directors. under the HK listing rules, a third of the board should be independent. We have a saying that no director is independent until proven otherwise, because they're nominated by the block shareholder. We are also focused on board composition to ensure competent directors are on the board. Some of the most competent directors I've met here are technically not independent, and some of the most incompetent directors I've met are technically independent. So our discussions around improving board quality, we see E&S being a function of G. If you can get the G right with appropriate, competent directors with a diversity of skills, the E and the S is managed much better. And we've just got to continue with those discussions. And fortunately, my team is doubling over the next 2 years. So we do hope to be able to do more work in this area.
Right, I might just touch quickly on the compliance, because I think that's a really good point to start with, and come back to the companies, because often if you look at the responsible sourcing codes that companies have, I think they're often based on local legal compliance, but in some areas that doesn't mean much. If you look at a country like Bangladesh, for instance, if an Australian retailer, for instance, says, well, we're gonna make sure workers in the factories receive a legal local minimum wage, that's a far cry below, say, a living wage, for instance. And that living wage gap is one of the key reasons why child labour is common, because the parents aren't earning enough. Another problem I've detected with companies too is often when they source from Asia, they might have one local sourcing office, for instance, based in Hong Kong, that's servicing, say, Bangladesh, Cambodia, Vietnam, and other countries. So I think companies can really up their game there. So there's quite a few touch points we have with companies where we encourage them to adopt industry best practice. And those things have often come from field trips. And it's really important, I think, when you go on a field trip, you don't get to see the worst factories, you never do. You get to see the best ones, but even that has value because you can learn from best practice. So one of the things we encourage companies to do is to build really long-term relationships with their suppliers. We encourage them to consolidate their supply chains, sourcing more from fewer suppliers, because you can have the best responsible sourcing code in the world. But if you don't have any influence over your suppliers, you're not going to move the dial. So quite a few companies have spread themselves out very thinly across a large number of suppliers. That's one thing. Another thing we often talk about is making sure the ethical sourcing team and the procurement team of the same company have the same KPIs. Because otherwise you have a scenario where the responsible sourcing team goes to a factory and says, well, we want you to upgrade your health and safety, for instance. We want you to pay higher wages. And from a factory owner's perspective, of course, that's an investment. And then 2 weeks later, the procurement team comes up and says, well, we want to have a 10% discount. And that just breeds mistrust. It means a higher risk of subcontracting. So it really comes back to that, building those long-term relationships with suppliers. And there's a whole other range of things we ask too, but I'll let the other speakers say something too.
Yeah, so I think that there are several challenges, and I think several of these challenges have been mentioned today. I think I would just summarize them as three. First is the scope of the problem. I mean, the scope is extremely complex. We're not talking about just companies dealing with their first tier of suppliers. We're really talking about companies are now responsible for addressing the issue of forced labor within their entire value chain. Huge challenge. And not just their entire value chain. And in the workplace, we're talking about addressing issues around how workers are getting to the workplace, as we saw before, recruitment-related issues and falling into modern slavery situations in that context. So we have to follow the labor chain. So a tremendous challenge there. The second challenge is really around leverage. I mean, especially in a situation, as I just mentioned, where it's such a complex, it's large, we know this is a systemic problem, and oftentimes individual companies simply don't have enough leverage to influence their direct supplier, much less 3, 4, 5 down the tier of the supply chain. And the same applies for investors who want to address this with a single company. What leverage do they really have to make a significant change? And the third challenge, I would say, particularly for investors, is access to information, to real, significant, relevant information on how companies are addressing human rights related risks, and in this case around modern slavery. And so those are 3 challenges, but I do want to say that I think they're just a couple solutions and they're good signs and we might be going in that direction. First of all, just to say that multiple multi-stakeholder initiatives are emerging to really support the investors in particular to address these issues, and the Investor Alliance for Human Rights is one of those opportunities that I think investors have to join when it comes, to increasing their leverage to make significant asks of companies. Investors of our alliance have actually created guidance for companies on how to address specifically recruitment-related issues and forced labor with a set of case studies. As was mentioned before, this is a much necessary, to engage a company on these issues. It's always good to point to other companies who have actually done it. So there's good signs there. And I also want to just flag that there is now the UN Guiding Principles reporting framework developed by SHIFT, which is an organization that is focusing exclusively on identifying how companies are reporting on their human rights risks and impacts. And that's available online and free. And there's a tailored function to it to assess how companies are addressing child labor and forced labor, not just at the policy level, right? But how they're integrating this. And this is online and available. So there are things happening. I'll close there.
I think just to wrap up, I think, if there are investors in the audience who are sort of slightly daunted by the whole process of how to start putting systems in place to address the risks that they have within their portfolios, I think a key thing that has been brought out before, but is to work with specialist, third parties to get organizations like SHIFT, like Veritas, like the Ethical Trading Initiative, like Ergon. There are a lot of really good organizations out there that can help identify where the risk areas are within your own organizations and then, within other companies that you might be associated with. So I think, that it's a really good way forward to get, experts in to help with these issues. And I know from a banking perspective, we've done quite a lot of work in trying to just do that, not only look at where the risk factors are in terms of the organization, in things like cleaning staff and, contract workers and things, but also then to get external help to look at where our supply chains are, which isn't necessarily an obvious thing for a bank to look at, but just to see, are there particular regions and sectors that are particularly high risk for this, and in which case do we have to put more frameworks in place in those scenarios to address the risks. But yes, I would just encourage, just to get support on these issues.
Well, thank you all for sharing your thoughts. Unfortunately, we are running out of time, but I think all of the panelists are in need of a good cup of coffee, so you may want to grab them during the upcoming break and ask any questions. Unfortunately, we didn't have time to take any from the audience, but thank you for listening, and hopefully this was insightful for everybody.
Thank you.